All right, many of you know that I'm a private lender and have been in private lending for many years. One of the things about investing in real estate through that way is you look at market trends, you look at the forecasting, you tend to look at the numbers of what's happening in real estate. Before this current government came into power, one of the things that I spoke against it was that people would have a harder financial time with their debts, with their mortgages, with their credit card, just because of the policies that they were bringing into place. Now, a lot of people thought I was crazy when I was saying that. And I told people that, look, this is an inevitability based on what they're doing. And I'm going to share with you guys some of the numbers that we are seeing based on what the impact is on Canadians, on their budgets, on their mortgages. We're going to look at some of these crazy numbers and how did we know that this was going to be the case? At the end of the day, we could see based on the policies, the restrictive policy that was going to be put into place by the Liberals, we knew that this was going to happen. The first thing we're going to look at is delinquency rates on debt. We're going to talk about the different quarters. First, second, third quarter. We're currently in quarter 3 of 2024. And so we've got quarter 2 of 2024, and we can look at the numbers from this year to last year. And that's what we're going to get into. Here we go. We have seen from Q2 2023 to Q2 2024, we have seen consumer debt levels massively increase to the tune of 4.2%. Now, 4.2% doesn't sound like much of a number, but we're going to get into what that really looks like because credit cards have actually continued to be the primary driver of rising debt. They've actually been the main driver when we're talking about outstanding balances. We're going to talk about delinquencies. So why does this matter? Because the number is somewhere around $122 billion, which is up by 13.7% from last year, from Q2 2023. And that gives you a real idea of how Canadians are doing in the economy for the last year. Okay, let's get into the mortgage delinquencies, right? We're talking about the differences in debt load and people having a harder time as a result. Mortgage delinquencies in Ontario are up 67% from last year to the tune of how many mortgages? How much mortgages are we talking about? We're talking about $1.3 billion. That's in Ontario alone. There is a 67% jump. Now, when you look at let's just look at the overall numbers. What percentage is that? It's actually a really small percentage of people. But we're looking at the number of people that 67% to the tune of $1.3 billion are now in severe delinquency. This means they're missing payments. This means that we're seeing an increase in power of sales, in default notices. The number of stories that I see with people that are in power of sale, because as a private lender, I'm trying to help people to be able to refinance themselves out of some of this unmanageable debt. When you're talking about credit cards in 22, 29%, you're talking about some of these extra high interest loans up in 30, 40%, those quick day money and fair and easy, those different financial places that you can make it real easy to get money. You're talking about 30, 40% in some of these cases. There is no way for people to get out of that type of debt load, but they're taking it on because whatever disposable income they had is now getting wrapped up into their mortgage. Now, I'm not saying if you don't own a home, I'm not telling you should feel sorry for them. I'm just talking about the impacts of what is going on for homeowners, for mortgage holders, as the interest rates had continued to creep up. Ontarians are hurting at a higher rate than ever before. And a lot of it has to do with these restrictive policies that we have in place, how quickly interest rates were jacked up, especially when people were expecting them to stay lower for longer. And as a result, people are having a harder time. Don't forget, we haven't even brought in the ugly word inflation. We haven't even brought that in. Okay, let's talk about this one other sector. This is an important number to look at. You can look at the state of an economy and get an idea of where it's going by looking at automotive loans, looking at automotive leases. The more leases that start coming on the market, you start to get an idea of what people can afford, can't afford. When you look at automotive loans and you look at their delinquencies, people are going to default on these things before they start defaulting on a lot of other items because they just can't afford it. You have to have a place to live. But before you deal with a place to live, maybe you give up your car or you downsize. Automotive loans are up 27%, and that's for non-bank loans. They're actually up 54% when you're talking about bank loans. We're talking about automotive bank loans, delinquency, people defaulting on their automotive loans from the bank is up 54%. A leading indicator of what is going on with people. People are running out of, why do I say running out? I should actually just say people have run out of money and they don't know what to do. And so in many cases, they're just giving up. It's a good time to be in the repo business. I'm not trying to sound callous, but that's the reality of what we're dealing with. I've said this previously because at the end of 2023, beginning into 2024, I was looking at vehicles, and it's one of these numbers that I look at, right? I just told you it's a secret. Go look at how automotive loans are doing. I started seeing an increase in the number of luxury vehicles that were hitting the market. In fact, in January of this year, 2024, I saw a 2024 Porsche up available for sale. That means that someone had just bought it and was immediately realizing that they couldn't afford it. That is a scary situation. So I started looking around, do some more research. How many Porsches are for sale? And at one point, I found over 1,000 Porsche, sports cars, luxury sports car. So it tells you that these people that are affected, they don't have the money for these. I'm sure many of those people probably thought they were rich and then found out as they were bleeding from all of their mortgages, realizing that they couldn't pay that, pay the credit cards, pay all of these things, and pay for their vehicle. And so they had to start offloading it. That's it. It's just an indicator. It's not the only indicator, but it's one of the things that you and I can look at to get an idea of which way the market is going.
When the ones around trusting their word, they walk the talk in the world of investment, they make their mark.